And it was expected. We know, given the pandemic hit and the adverse effect to risk sentiment, that the S&P had been intervening in Q2 quite aggressively to ensure that Euro Swiss is not going to be pressured significantly on the downside. So to a certain extent, I think the markets were really expecting that. And at the same time, we have to take into account that this was the last report produced by the current administration. I think as far as the S&P is concerned, it's not really a game changer for them. I think they're also betting to the fact that we are in a global upswing, in a recovery mode right now as far as trade and growth is concerned. Risk sentiment seems to be quite strongly supported, largely on the back of the vaccine developments. So I think what they're betting on is that they won't have to deploy further FX intervention because eventually the Swiss franc is going to weaken on the back of strong risk appetite.
Yeah, exactly. I mean, it felt like coming into today, before that news came out of the Treasury Department, that the outlook for the Swiss franc was one of downward pressure, a weaker 2021 than 2020, given the rest of the world is poised to see a recovery compared to what we saw in 2019. So do you think that we will see the S&P intervene less in reality in 2021?
Well, I think that's largely going to be a function of risk appetite and euro area specific risks. To the extent that things evolve according to our base case, which I have to say is very much close to consensus, meaning that there's going to be a recovery in euro area growth and therefore risk sentiment is going to be supported, then yes, we are very much likely going to see the S&P intervening significantly less in the FX market. The other thing which is quite notable, and not a lot of people have actually picked up on this, in Q2, towards the end of Q2 last year, we've started seeing some signs of Swiss residents being enticed into diverting portfolio flows abroad. Now, we don't have yet data for Q3 and obviously not Q4. Potentially, we had a slowing down in Q3 because of the pandemic. But if indeed we are going to see a revival of that appetite by Swiss residents to direct flows abroad in Q4 and potentially in 2021, then this is likely to be supportive of the hypothesis, of the thesis that the Swiss franc is going to weaken in 2021.
That is a really interesting data point. We'll have to look out for confirmation of that in the weeks ahead. You seem quite bullish on the euro area and the outlook for the European economy next year based on those initial comments. We have seen the euro break through the 122 level already. It hasn't done that in more than 2.5 years. How much further does the euro have to run here?
Well, I mean, it's one of these things, Julian, where you have to balance the fundamentals with the momentum. As far as the fundamentals are concerned, we have an estimate of fair value close to 120, thereabouts. But based on empirical assessment, we know that euro-dollar does tend to overshoot or undershoot, in either case, fair value by approximately, say, 5% on a multi-month horizon. So I think 125 is going to represent a reasonable resistance level for euro-dollar. But at the same time, you have a lot of dollar bearishness and you have a lot of momentum behind the euro. So it's not inconceivable that euro-dollar could trade between 125.30 to 130. But I think right now, close to 123, the risk reward of staying long euros seems a bit unattractive to me from a fundamental standpoint.